Ladies and gentlemen, good day and welcome to the Salasar Techno Engineering Limited Q3 FY22 earnings conference call. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference, please signal an operator by pressing star and then 0 on your touchtone telephone. Please note that this conference is being recorded. I now hand the conference over to Mr. Vikash Verma from Christensen IR. Thank you, and over to you, sir.
Thank you, Rinba. Good afternoon, everyone. Before we proceed, let me remind you that the discussion may contain forward-looking statements that may involve known or unknown risks, uncertainties, and other factors. It must be viewed in conjunction with our business risks that could cause future result, performance, or achievement to differ significantly from what it is expressed or implied by such forward-looking statements. To take us through the financial results and developments and answer your questions today, we have the senior management of Salasar Techno Engineering, represented by Mr. Shashank Agarwal, Joint Managing Director, and Mr. Pramod Kumar Kala, Chief Financial Officer. We will start the call with a brief overview of the past quarter by Mr. Agarwal, followed by a Q&A session. I now hand over the call to Mr. Shashank Agarwal. Over to you, sir.
Thank you, Vikas. Good afternoon, everyone. On behalf of Salasar Techno Engineering, I welcome you all to this earnings conference call to discuss the financial performance for the quarter 3 and 9 months ended 31st December 2021. I hope everybody is safe and is in good health and is taking necessary precautions in these current times. We have already uploaded the investor presentation on the company website and the stock exchanges, and I hope most of you must have gone through the same. Salasar, with its persistence, expertise, and capability to work wonders with steel, today is no longer confined to towers, but has expanded its range of products and services to encompass all the infrastructure needs of this rapidly developing nation. We have been delivering consistent financial performance driven by contribution from each of our business segments, along with our approach to diversify and enter newer segments. The company reported a revenue of rupees 507 crores in 9 months FY 2022 as compared to rupees 385 crores in 9 months FY 21. Manufacturing of steel structures contributed 75%. EPC for power transmission contributed 20%, and EPC from railways electrification contributed 5% to the overall revenues in 9 months FY22. This was 83% from manufacturing of steel structures, 11% from EPC for power, and 6% from EPC from railways electrification during the same period last year, that is 9 months FY21. EBITDA during 9 months FY22 was at rupees 53 crores as against rupees 38 crores in 9 months FY21. EBITDA margin at 10.4% improved from 9.8% reported during 9 months FY21. The company reported a PAT of rupees 24 crores in 9 months FY22 as compared to rupees 20 crores in 9 months FY21. Moving on, quarter 3 FY22 performance, the company reported a revenue of rupees 174 crores in line with rupees 174 crores reported in Q3 FY21. EBITDA was at rupees 17 crores with an EBITDA margin of 9.63% in Q3 FY22 as against rupees 18 crores of EBITDA and 10.3% EBITDA margin in Q3 FY21. The company reported PAT of rupees 7 crores in Q3 FY22 as compared to rupees 12 crores at Q3 FY21. We have an overall order book of rupees 1,030 crores as on date, underpinned by robust order inflows from reputed customers at our new growing verticals of heavy steel structures division. The breakup of the order book as on 31st December is that we have unexecuted EPC orders of rupees 695 crores and EPC orders of 95 crores, where we are L1, and the LOIs or the orders are expected. Manufacturing orders outstanding under heavy steel structure unit of rupees 163 crores and rupees 77 crores of export orders in hand. The heavy steel structure division of the company, which was started recently, is witnessing good traction. As on date, the division has an unexecuted orders of worth rupees 163 crores in hand, and the company is in negotiation with some leading customers for supply of structures. As on 30th September 2021, the unexecuted order book was rupees 61 crores from this heavy steel structure division. At present, the company in HSD division is having robust order book, and the plant is fully booked for manufacturing for next 1 year for supply of rail, bridges or road over bridges, plant structures and prefabricated building structures, etc. To cater to the high industry demand, we are expanding our product portfolio with optimal utilization of existing capacity as well as undergoing few capacity expansions. Our capex program is progressing as per schedule, and we expect the new galvanizing unit with a capacity of 96,000 metric tons to be commissioned by September 2022. Post-commissioning, it will become the largest structural galvanizing plant in Asia, based out of our Unit 3 in UP. We are also setting up a second plant of 25,000 ton metric capacity for heavy steel structure division in Bhilai, Chhattisgarh, at a cost of rupees 40 crores. The plant is also expected to be commissioned by September 2022 and will help us tap opportunities in the eastern part of India. The company sees a lot of opportunities as telecom operators are working their way towards improving their connectivity. The telecom companies have again started to execute their capex plans for installation of new towers for 4G and forthcoming 5G. And recent telecom package announced by Government of India for telecom sector has boosted the overall sentiments of the industry. Railways electrification and prefabricated heavy steel structure continues to remain a key growth segment and focus area for us. As the country continues its growth trajectory, we stand tall, partnering to bridge the gap in nation's infrastructure needs with our sustainable and efficient business model. Our differentiated positioning in the country's most dynamic sector will accelerate our transition to diversified and agile business to better serve our growing clientele. As of now, this is all from my side. I would ask now moderator to open the floor for question and answer session.
Thank you very much. Ladies and gentlemen, we will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Anyone who has a question may enter star and 1. We will take our first question from the line of Sandeep Jain from Soma Capital. Please go ahead.
Good afternoon, sir.
Good afternoon.
Sir, I would like to understand, how much volume did we do in 9 months of the current financial year, and what is our, current capacity utilization level?
In terms of tonnage, the capacity utilization is at around 45% as of now. Okay. For the 9 months, and I think we did close to around 34,000 tons. Okay. So in this case, so why do we require significant amount of capex for the new capacities when our existing capacity utilization level gives us good headroom for more revenue? So there are two things. There's one expansion for the galvanizing plant, which actually caters to one particular product. Okay, so that is the larger diameter size monopoles. So this plant would serve two purposes, as I had mentioned earlier in my earlier discussions also, that we'll be able to utilize this plant for our existing products, wherein we will have one of our plants as a standby. So it is, you can say that enhancing the capacity in terms of size of the plant,
Okay.
which would give some additional capacity, and we'll have one of the plants as a standby. And this new plant would give us efficiency in two ways. One is that it will improve our operational efficiency a bit, plus it will serve to certain size of structures, which would be a kind of a monopoly structures for us, wherein the realization of margins would be better.
Okay. So
And as far as the capacity goes, it keeps on varying. This year we have worked at around 40-45% capacity. Last year we were running it almost at the brim. So during this last 6 months, actually, there was in the domestic sector there was a little less visibility from the telecom sector because of the merger of Indus and Bharti Infratel, and telecom operators actually waiting for the government's view as to how the telecom sector is going to progress in the coming times. And after the clearance, a lot of visibility from the government, and giving the telecom sector a sort of a relief package. The telecom industry is now consolidating, and the demand is being generated now. And the current quarter, we are operating at a much better efficiency and capacity.
Okay. So, any guidance in terms of volume and value for the current financial year as well as FY23?
So I think last year we did close to 593 crores as a top line. This year we should be closing 700 crore plus.
Okay. And what's the target for next year, sir?
Again, a growth of almost 20%, 25, 30%.
Okay. And in terms of margins, as you mentioned that our focus would be a better value addition products going forward. So are we expecting any improvement in margins going forward?
Yes, once the new galvanizing plant comes and running, the structures which we especially going to manufacture in those plants would definitely give us better margin. Plus the new segment of heavy structure division, wherein we have very good order book from Larsen & Toubro for our Mumbai Ahmedabad bullet train project, wherein this plant is booked for next 1.5 years. The margins are consistent and better, which will improve the EBITDA margins overall, plus the utilization of the plant.
Okay. So can we see 11-12% kind of EBITDA margins going forward?
See, it's difficult, but yes, I think this year we are running close to plus minus 10%. We definitely see improvement on EBITDA margins going forward.
Okay. And how do commodity prices impact us? How our contract structure in terms of pricing on?
Commodity prices actually affect us in only one way, that our inventory carrying costs go up. But we have price variation clause with almost all the customers, barring a few wherein very small projects are taken on a fixed price contract basis. The long-term projects all are on price variation clause, so those are like pass on costs.
Sure. And what's our current debt level, sir?
So we are at debt level of 227 crores, of wherein we have fund-based limits of 195 crores as a cash credit limit, and we have 32 crores of GECL. Plus we have bank guarantee limits of almost 200 crores. These are non-fund based.
Okay. Then the capex which we are undertaking currently, would that be funded through internal accruals, or we will be taking some term loans for that?
So for the new galvanizing plant, we have already tied up for a debt of with the bank, 37 crores, which is already approved. So, and 12 crores is from our internal accruals. So that capex is almost 50 crores. So 12 to 13 crores is from our internal accruals, and balance 37 crores is the long-term debt from our bank. And for the Bhilai plant, we have some plans to start with use our internal funding, but we would also like to raise some capital to fund that project in Bhilai.
Sure, sir. Thank you so much for all your answers.
Thank you, Sandeep.
Thank you. Before we take a next question, we'd like to remind participants to ask a question. You may enter star and 1. Our next question is from the line of Vivek Kumar, an individual investor. Please go ahead.
Good afternoon, sir.
Good afternoon.
Sir, I have few questions regarding your current debt level, margin, and any plan to reduce your debt level?
Sorry to interrupt. Mr. Vivek Kumar, if you're on a hands-free or speaker mode, can you switch it to handset and speak? Your audio is not clearly audible, sir.
Yes. So actually, the company plan to reducing debt in next 12 months or 24 months. Does company have any visibility?
No. See, we are in a growth phase. There is no way that we would be able to reduce the debt level as of now, since we are already expanding, and we are looking at a growth of almost 25-30% next year. So there is no way that we'll be able to reduce the debt.
And sir, you do projects for railways also.
Yes.
So I mean, because a railway project could be larger project in coming years from the government of India. So are you aggressive for bidding railway projects, sir?
So we are aggressive for bidding, but we would like to keep our margins protected. We are not in a rat race. We don't get and jump into every project. But yes, we study the project carefully and we bid at our own prices. We have from railways, we have more than 300 crores of order book running at the moment. And
so current order book from railway project is 300 crores, sir.
250 plus, yes.
And current revenue percentage, sir, from railway project?
This year it was around, in 9 months, around 5%.
5% only?
Yeah, around 25-30 crores from railways this year, 9 months. But another 15-20 crores would be coming in this quarter. So from railways alone, this service, that's only the service portion, which will be close to 40 crores.
Okay. I mean, like for FY23, I mean, do you have any visibility for railway project? 10% or 15%?
We have an executed order book of almost 250 crores for FY23, wherein most of the revenues would come in during FY23 and partly in next year after that.
Okay, sir. Okay, sir. Thank you so much, sir.
Thank you.
Thank you. Anyone who has a question may enter star and 1. Our next question is from the line of Rajesh from Bothra Investments. Please go ahead. Mr. Rajesh, can you please unmute your line and go ahead with your question? Rajesh from Bothra Investments, can you please unmute your line and go ahead with your question?
Hello. Am I audible?
Yes, sir.
So basically, what I understand, we are into multiple business segments and each segment has its own growth trajectory. I would like to know...
Your audio is a bit, echoing.
Okay. Is it better now?
Slightly. Not much. But yes, please go ahead. Hello? Hello?
Rajesh, are you still there on the line?
Hello.
Yeah, it's better now. Please go ahead.
What I want to understand is we are into multiple business segments and each segment has its own growth trajectory. I would like to know what kind of business is coming from government orders and what is from private orders in each of the segments.
So telecom is private, almost 100%. I would say 95%.
No BSNL, MTNL orders?
No, we don't work with BSNL and MTN directly. Yes, we are working with ITI for their ESCON project, a defense project of national importance, which we recently got orders of almost 60 crores. So I would say telecom primarily is a private business, okay? And the EPC business is all government business.
Okay.
And solar business, wherein we supply solar structures or monopoles, we supply to a lot of contractors. We supply structures to companies like Larsen & Toubro or Tata. There are so many other companies, the EPC contractors. That's all private business. The EPC contracts which we are working on our own, 100%, are government businesses basically.
Okay. And secondly, in the segments, are we directly dealing with the customers, or is it we are subcontractors as well?
No, we are directly dealing with the customers. Like we have customers like Airtel, Indus Towers, American Tower Corporation in telecom.
In none of those segments we are subcontractors for any of the main contractors.
No.
And what I gather and understand from the financials is we have a margin of around 10-11%. So cost is roughly 89-90%. And of the significant part is raw material.
Yes.
So raw material plays a key role in our enhanced profitability, if at all. What are the metrics for backward integration or assured supply of raw material at lower or cheaper cost? Do we hedge something? Do we import?
Our raw materials are commodities basically, either it is steel or zinc, right? And the commodity prices are driven by certain market forces in terms of supply and demand, and they're very open. It's not that I can, if I have a requirement of 10,000 tons, I can go to a supplier and ask for a discount. The commodity prices are more or less open and they're fixed for everyone, whether by 10 tons or 20 tons. Yes, commodity prices, when you go and buy, there could be some volume discounts available. Beyond that, there's no way that you can procure cheaper material. Import is out of question because India itself is even today at these prices, India is cheapest in terms of steel production. Zinc is also available locally and is at par with the imported commodity prices of zinc. As far as backward integration is concerned, we haven't thought about it, till now.
Because there is no room scope for as such improvement in margin on account of input cost, because whatever increase or decrease will happen, we need to pass it on to the customers, or we need to take a price hike.
No. So we have a price variation clause with most of the customers, and the prices are adjusted every month, depending upon the previous month.
So margin expansion scope is not there, so it will remain range bound in the next 9 to 11%.
More or less,
there
yes.
Is no room for margin expansion.
More or less.
Right, economies of scale kick in, but since those will not help out because 80% of the cost is itself raw material.
No, but see, that is the reason that we are getting into newer products and lines. Like we are putting up the largest galvanizing plant, which would cater to monopoles of higher diameter sizes, which would definitely improve our profit margins because there will be a kind of a monopolized item.
Right. But still, I don't think it would exceed 12-13%?
No.
Overall? Blended level?
No.
Okay.
No, I mean 10-11% by industry in that standards is also one of the best margins probably we have compared to if you compare our peers, probably we are best placed in the industry.
Okay. So what would be the best segment in terms of margin profile, if at all, or does all six segments have similar margin profile?
See, more or less, steel and zinc are commodities which are open for everyone, right? And all the private customers, when they do the costings, these costings are done on a very transparent, manner. Because they're passing on the cost to us, we are passing on cost to them depending upon the price variation clauses. So, when you are dealing, corporates and big multinationals, the margins are limited in the range of 10 to 12% only. Yes, sometimes you can take advantages of some commodity price decrease sometimes, but not much. More or less, the margins are going to remain within this range only.
Right. But sir, when I look at your working capital 5-6 years before, we were at much lower level as compared to current level. Not only the absolute amount, but as a number of days as well. So even if we earn 10-11% margin, considering the capital blocked in working capital, funding cost will also be there. So hardly less than 10% margin profile would be there at absolute level.
So even after paying the interest cost and everything, we've been able to maintain a PAT of almost 5%.
Okay.
Yeah. So see, I mean, if you compare this year compared to last year or year before last, the steel prices have almost doubled. The cost of inventory itself has doubled. The working capital has doubled almost.
Right. What I was looking at is, in case of investments in the company, the only way to look at is the growth in terms of business. So if at all, last 5 years, though there has been no as such survey or study available in each of the verticals, that what was the quantum of orders allocated and what is our share and how is our share moving and what will be the future growth path. So let's say 3 to 5 years, where do we see our company in terms of the revenue and margin will be more or less in the same, but in terms of revenue. So doubling of or tripling of revenues, how is it?
In 5 years, I see myself, as Salasar at a revenue level of almost 4 to 5 times from here.
4 to 5 times. So that will throw up, and if there is an operating leverage kicking in, so definitely that level it could be 6 to 7 times.
Possibly, yes.
Okay. I'll come back in the queue in case.
Sure.
Thank you. Anyone who has a question may enter star and 1. Our next question is from the line of Amit Shah from Antique Stock Broking. Please go ahead.
Hi, good afternoon, sir. Thanks for the opportunity. So my question was pertaining to the L&T order that you shared on the call. So if you can just throw a bit more light on the order, what is our scope of work, what is the size of the order, by when do we intend to complete this particular order, and incrementally if it's a fixed price order or a variable price order. So if you can just give us the details of the orders and how the revenue will turn out.
Sure. So this order is for the bridges which are going to be built on the bullet train project from Mumbai to Ahmedabad corridor. Okay, L&T has got a contract from National High Speed Railway, and the project is being monitored by the Japanese, the original design owners of the whole project. L&T has approved our plant, the new plant which we have put up for the heavy structure division, and the order size is of almost 10,000 tons, valuing at around 125 crores. And this project would go on for at least 12 to 15 months to be completed. Our scope of work is that we supply the structures as per their design under their supervision of quality and everything. And yes, there is a price variation clause, and L&T has control over price variation, wherein they'll be finalizing the prices of raw materials which will be passed on to us. And we have a labor component agreed with them over a period of next 10 to 12 months. And yes, we expect this order to even go up as soon as the first order is completed. Probably it might double or triple, after a year or so.
Okay. Sir, what would be the total quantum? As you pointed out that, 125 crores is the initial order, and incrementally we intend to, or we expect furthermore orders from L&T. So, in totality, if I look at the high-speed rail overall size of the project, what could be the
overall requirement for this one corridor itself is close to 40,000 tons to 50,000 tons. Okay. And, after this, even the work is just started in the first corridor. The government has already announced 7 more corridors like this.
Mm-hmm.
So, for the next 5-7 years, this particular work has some very huge potential.
Okay. And any expansion plans on the lines of the kind of visibility that we have in terms of the incremental corridors as well as the L&T giving us incremental orders?
Yeah. So as I mentioned, the new plant which we have put up in UP in our Unit 3 is already booked for next 1.5 years, and we expect that this will be permanently booked by L&T or someone like L&T, for future. So we already started planning a new project in Bhilai, wherein we would be making the welded structures for our customers in eastern part of India.
And sir, what would be the capex in terms of?
As I mentioned in my initial listing, the capex is going to be 40 crores in Bhilai plant.
40 crores. Okay. And what sort of top line it can generate, sir?
Should be generating around 250 crores plus.
Okay. Incrementally, sir, you told about, over the next 4-5 years, you intend to significantly grow your business and the revenue can significantly improve. So what is the kind of mix we are looking going ahead? Will it be more in terms of heavy structures or transmission lines or the telecom tower that you are doing? So if you can just help us understand which are the areas which can help you deliver such a strong sort of a growth on the top line front.
Okay. So telecom, I see a consistent growth of not more than 8-10% per year. This year probably we'll be doing around 350 crores. Next year also we'll be doing somewhere between 350 to 400 crores, plus minus. So for next 4-5 years, probably we'll be doing 400 to 500 crores of that on the telecom front. Right?
Yeah.
I expect a very good top line coming in from our heavy structure division. Right. So probably we'll have a capacity of 40,000 tons next year by this time per annum, which itself would give us a top line of almost 400 crore plus.
Okay.
Right.
Okay.
And of course, when we have the new galvanizing plant running, we'll have good capacity of galvanizing for monopoles, which would again give us a good top line from there. So these are 2-3 areas of focus, which would actually give us the top line, additional top line.
And sir, how are the margins in this particular 2 segments, the heavy structure and the monopoles? They are similar to telecom?
Monopoles will have slightly better margin because those will be one of the only plants in India or rather in Asia, wherein we would be able to take some premium from the customer, right?
Okay.
Because of our capacity availability. As far as heavy structure division is concerned, typically again you are dealing with all big customers and corporate to corporate when they sit along across the table. The margins are typically range bound in terms of 11 to 12% probably.
Okay.
Yeah.
And sir, one last question on the retention money side. So if you can throw some light, I think so you were supposed to receive some retention money for the projects that you have completed. So what is the status? What is the current retention money on the balance sheet, and what is the status of us receiving the same?
Okay, as of now, we have a retention of almost 23 crores. And we expect, this is started realizing. We are getting some money in this week. Plus, over the next 2 to 3 months, we should be able to get all these monies.
Okay, so by year end, sir, what would be the number on the retention money, sir?
More or less, it should remain in the range of around 15 to 20 crores because there will be some retention money of some other project coming in.
Okay.
Yeah.
Okay, sir. Thanks a lot. That's it from my side.
Thank you
very much.
Thank you.
Thank you. Before we take our next question, we'd like to remind participants to ask a question. You may enter star and 1. The next question is from the line of Sandeep Jain from Soma Capital. Please go ahead.
So you mentioned that you are looking at significant increase in our top line in next 4 or 5 years. So are we expecting that kind of new orders coming in from the government, or would it be some new segments from where this growth would come in?
So see, the focus of the government at the moment is to improve the infrastructure all across the country, right? The focus of the government is to make Indian economy to what the numbers are of 3 trillion economy and all that, right? The steel production capacity in India is increasing, and there is a plan to increase the capacity from the current capacity to almost 3 times in next 10 years. By 2030, the government would like to have the installed capacity of steel manufacturing at 300 million tons, which is at around 105 million tons today, right? So all the steel plants which are going to increase their capacity are going to require a lot of huge structures to put up those steel plants. And we are actually, focused, and we are consistently following that sector, wherein we would be supplying the structures, prefabricated structures to these steel plants, whether it is Tata's or Jindal's or anyone. So I see a lot of growth coming in from this particular sector in the coming 3-5 years. And that is the reason that I am very bullish on, top lines going 3 to 4 times from here in next 3 to 5 years.
It will be driven more by private capex rather than government capex.
The government capex at the same time is a focus area by the government. You can see that a lot of the railways spending is quite clear. Every day there's a new project coming in. Even in transmission, every day there is a new project coming in, right? Highways, there are projects coming. So we have the good demand of lighting poles, lighting masts, railway structures, right? So everything, yeah. So, but we are in fact, at the right industry at the right time kind of a scenario, because there's a lot of spending going to be happening in infrastructure sector, whether it is from government or from private or from telecom, everyone.
Okay.
But at the same time, we had clarified earlier also, EPC segment, wherein we are doing the complete EPC project. We would like to limit that sector because of the cash flows and the retention money, and focus more on manufacturing.
Okay. And, so you have some export orders also. So these orders cater to which countries?
So we are primarily executing export orders of telecom towers at the moment, and these are for Philippines and some African countries.
Okay. So we manufacture in India and supply to these.
Yeah, we are manufacturing at our plants, and we are supplying to all these countries in Africa and in Southeast Asia.
Sure. And in terms of debtors, are we expecting any improvement in debtor days going forward, or these would remain largely at the same level?
No, we are expecting some improvement to happen as the EPC business is limited, and the manufacturing portion increases. Of course, the number of debtor days would come down slowly.
Okay, sure. Thank you so much.
Thank you.
Thank you. Anyone who has a question may enter star and 1. Our next question is from the line of Rajesh from Bothra Investments. Please go ahead.
Hello.
Yes, sir.
I just wanted to understand more clarity on the telecom side. There are, I think, 3 key players, rather 2 key players, Reliance, Bharti, and Idea being on the revival mode. How are payment terms from these entities, and what is the strategy going forward in terms of 5G and other new age technology?
So, the 5G spectrum auction is expected to happen somewhere in the month of April or May this year, right?
Right.
And right now, the traction is coming from expansion of 4G in rural areas, wherein new towers are being put up. 5G is going to add many points of connectivity. I had mentioned earlier also in my Concalls and discussions with various people across various forums. Today, India has close to around 600,000 towers running and operating. And considering an average of 1.35, 1.4 tenancy, we have close to around 820,000 points of connectivity, right? For 5G to be effectively rolled out all across the nation, probably we need to double these towers from here in next 3 to 5 years. These 600,000 towers have happened during last 25 years, and we need similar number of points of connectivity in next 4 to 5 years if we have to roll out 5G effectively. Yes, the current year has been slightly subdued because of the telecom sector going through a bad phase. Vodafone having its own problems, Indus Bharti being merged together, the clarity coming from Airtel. and now Reliance Jio has sold its towers to certain investors, and now there's a clarity coming in from them, from Jio. Focus is going to be expansion of 5G in a huge and big way. Yes, the size of the towers is going to be smaller, but the number of towers are going to be huge. And the real traction, I should say, that would be seen from probably second quarter of next financial year. And going forward, that would remain a focus area for next few years, wherein, all the players would be trying to achieve as much space as possible. You have seen that the operators have increased their RPUs. They've increased their tariff plans. The ARPUs are getting better. And I expect operators to again increase the tariffs in maybe 3 months or within 6 months, so that they can get better ARPUs, which would actually fund all these investments.
So on the telecom again, if we look at the previous upgradations, what was the quantum of capex which they did, and what was the quantum which was assigned to business which we are into? And similarly, what kind of quantum of business can come through 5G? And how many players were there to grab that business? Let's say total capex on upgradation was 10,000 crore, of which our related business was 2,000 crore, and there were 10 players. So each player could get around 200 crores. So I'm trying to gauge the size of the business which could come from the technology upgradation at telecom side.
So probably the whole expansion of 5G would go somewhere in the range of 1 lakh crore to 2 lakh crores, okay, over a period of next 5 to 7 years, okay. And probably 10% of what is the business would come to people like us.
Okay.
Right. So maybe 10 to maybe around 20%, depending upon the kind of towers they use, depending upon kind of infrastructure they use. Because the idea is to make very low cost effective sites, low cost sites, so that their capex is less and the number of sites are more. And there'll be probably primarily 3 or 4 players grabbing that business, apart from maybe 5-7 players which are in a smaller size.
Okay. And I had read somewhere that barring US, 5G technology has no major concern as such. I don't know about the health hazard, but otherwise no concern. But in US, some flight disruption news were there. Air traffic control was not very much compatible with the 5G technology. So how are things at the Indian side?
So it's very difficult for me to comment on that actually, because there's no specific data available.
But I guess you would be aware with such developments in US.
So there are views. There have been always different kind of views on telecom, right?
Okay.
One side there are activists who are opposing telecom towers. On the other side, there are people who have, even WHO has said that telecom towers are safe to be used. And today the reality is that you cannot imagine your life without a mobile telephone.
That's true.
So telecom towers are an essential part of our everyday life today, wherein we need to get connected, continuously.
Right.
So it's very difficult for me to comment on the technology's, pros and cons. But yes, there are all sorts of views available all across the nation. But yes, the reality is that it's going to happen.
And can there be possibility of merger and acquisition in our space? Are there opportunities available? Small size, large size?
We are not looking at anything as of now. There might be some possibilities somewhere in future, but nothing as of now which is available in front of us, or rather we are interested in anything.
But I guess there would be some stressed asset available on the block.
Possible. But we have enough capacity available, so there's no reason for us to acquire any other unit, right?
Right. But considering growth opportunity which you mentioned, 3x, 5x revenue in...
Assets are always available. As soon as we have the capacity exhausted, and we see an opportunity wherein we could make money by acquiring some other site, probably we'll do that.
Lastly, forgive me for my ignorance. Are the promoters have any other business ventures as well apart from this one?
No, nothing. We all are totally focused in our this business. We don't have anything else to do or to.
Okay. So if in case a larger player comes and wants to acquire, can there be a possibility for such sell out?
It all depends,
Right. No, but the mindset. No, but I agree. It all depends upon the valuation. But at times, what happens is there is no other business venture. Whether the promoter are willing to exit or not, that is also a question.
Very difficult to comment on this. This is a very hypothetical question.
Okay.
It doesn't have neither it has a relevance here nor we have not thought about it actually.
Okay, sir. Okay, fine. Thank you, sir.
Thank you.
Thank you. Any participant who wishes to ask a question may enter star and 1. As there are no further questions from the participants, I would now like to hand the floor back to Mr. Shashank Agarwal for closing comments. Over to you, sir.
Okay. Thank you, ladies and gentlemen, for being with us during this conference call. And I wish you all that you stay safe and sound during these tough times. And if there are any questions, we have extension available for you, and we can directly contact our investor relations team. Thank you again.
Thank you, members of the management. Ladies and gentlemen, on behalf of Salasar Techno Engineering Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.